Right. So thanks everyone. Today I'm going to talk about Deliveroo and the London Stock Exchange. So for those of you who don't know, and that's mainly our American friends and our people over in Europe, Deliveroo is a food delivery service. So it's one of those ones you go on an app, you select your food from whatever restaurant you want, could be multiple restaurants at once, and you order it. And some weird-looking student on a bike will eventually turn up with your food in a big boxy bag on their back. And they have decided to go public. And what's interesting to me is that they've decided to go public on the London Stock Exchange, which is not what you might expect from a tech-based company. You might expect them to go on a different exchange like the New York Stock Exchange. So first of all, let's talk about from the perspective of the company. When a company wants to go public, when they want to go do their IPO, they've got a couple of places that they can list. And they can list on multiple markets at once, but not all listing on one market doesn't mean they're listing on all of them, okay? So they've got to decide which ones they want to list on. And for each one they want to list on, they're going to be paying fees, they're going to be paying services to the regulators in that country. So it's important that they only choose the ones that they really need. So as I said, Deliveroo is a big tech company. So why didn't they list on the New York Stock Exchange? That's the typical destination for tech companies, places like Amazon, Google, Netflix. These are all companies that list on the American exchanges. And they do that for a few reasons. One of them is that the American markets have much higher trading volume. So there's a lot more people buying and selling shares because that's just where there's a lot more money, a lot more capital available. And that can help drive up the valuation of your business. As we said before, more buyers can drive up the price. There's also more sellers, which help to theoretically keep it in balance, but there's still more money available. However, that the New York markets and the other American markets come with attached more competition because of that increased capital. So there's a lot more companies vying for that same money. So new companies like Deliveroo might have some difficulties attracting those investors that they might not in other places. The American markets also have a lot more litigation, a lot more regulation around them. And they have a huge number of really expensive lawyers, really highly paid lawyers, who are ready to sue anyone and everyone for any change, any mistake they might make. So an issue with accounting, with your reporting, anything like that, you're liable to get sued. So that's a bit of an issue with the American markets. Now, Deliveroo is a UK-based company, so they could list on the London Stock Exchange. Now, London's a smaller market. There's about 3,000 companies just on the New York Stock Exchange, and there's only about 1,000 on the London Stock Exchange. So companies, when they're starting out, can have a bit of a better chance of getting noticed. However, the reason there's less, the reason there are fewer companies on the London stock market is because there's less capital available in the London stock market. So maybe your valuation for your company is going to be lower, and you're going to get less capital for your investment, for your development as a company. There's also less litigation. So in London, if you make a mistake, maybe with your accounting or with your reporting, people are maybe more likely to just point it out to you and get you to fix it rather than trying to sue you for all the money that you have available. With London, perhaps a big pressing issue that we've got is that we've got Brexit going on, or Brexit has happened now. The day after Brexit, London lost $10 billion worth of trading in the first day, just because they've got less easy access to the European markets and people move to the European markets. So maybe Deliveroo could then be listing on Amsterdam, the Amsterdam stock market, if they want to have access to the European capital. So you can see there's quite a lot of options, and this is just a few of the exchanges in the world. You could go to Milan, you could go to Hong Kong, any number of places, and each one has its own advantages and disadvantages. So why did Deliveroo choose to launch on the London stock market? Well, in part, it's due to the upcoming changes from this fellow. So this is Lord Jonathan Hill. I instinctively dislike lords, as well dislike anyone who doesn't seem to have a chin. He's just got like a bit of a tube coming from the shoulders up to the top of his head, which I said does matter to us. So we're going to ignore his face and kind of focus on the details. So he did a review recently, and when I say recently, I mean last week, about changes that should be made to the London stock market to make it more competitive in the modern era. Because the London stock market has been around for a long time, and that's got some advantages. So it's a bit old-fashioned in the way it does things. The first change that he suggested that's been taken up by the government is to have dual-class share structures. So that might seem like a bit of a, who the fuck knows what that is? But let's just talk it through. So on the London stock market as it stands, companies are only allowed to have one type of share, and that is just your ordinary share. And that means that we as investors get the same ownership in the company as the CEO who owns those shares. Okay. Now, obviously, we probably have a smaller ownership because we don't have as much money as them. We don't get gifted shares as part of our compensation, but those shares that we buy have the same voting right in the company that the CEO's shares have. So what that means is, when you're older and wealthier and you accumulate more shares in a company, you can actually have a real say in what the company does. And that's pretty attractive to us as investors. But what it's not attractive to is the founders of companies, because people don't want to give up ownership in the company they created. Chris talked a couple of weeks ago about IPOs and how companies listing, their advantage they get is they get capital from lots of people, and the disadvantage is they have to give up control. Well, with dual class share structures, which are quite heavily favored by American tech companies, they don't have to give up quite as much control because there's two different classes of shares. You get your ordinary shares that people like us can buy, and when you buy those, you buy a right to a part of the profit of that company. But then they've got other class of shares, which is what gives the voting rights in the company, and that's kind of tends to be kept for the founders and for the executives. So Jonathan Hill has suggested that this should be allowed on the London stock market, which will attract more tech companies like, for example, Deliveroo, as well as just other companies in general. He also suggested that companies should have lower float requirements. So at the moment, now the word float is something we've not discussed before. It's quite simple. It's just the amount of the company that is on the market, okay? So on the London Stock Exchange, to list there, you have to have 25% of your company sold to the public on there. And that is, it's not a huge amount, but he suggested that it should go down to 15%, which again reduces the loss of control that the founders and executives might experience when listing. So it's again, it entices them to list on the London market. And finally, he's suggested that we prepare to allow special acquisition companies. Okay, and we're going to come on to what those are, but they're essentially a different version of an IPO. Okay, we're going to come into more detail. So it's important to note about all these changes that these advantage the companies listing. They don't advantage us as investors. The lower float requirements don't have a massive difference, but the dual class share structure is a big disadvantage to us as investors, particularly as we become larger investors, but it's a huge advantage to companies. So it's an interesting balance they're trying to make. So what are SPACs? I said the name. They're special acquisition companies, and they're designed to take companies public in a different way to an IPO. So just to remind you all what an IPO is, there's a lot of stuff that happens behind the scenes when a company wants to go public. They go to investment banks, they figure out what their valuation should be, they figure out how many shares they should list, all this stuff. They figure out where they want to list, as Deliveroo has done. But the basic process that we see is the company lists their shares on an exchange, and then as investors, we can buy those shares from the exchange, from other people at the exchange, and we gain gain ownership in the company. And that's pretty straightforward. SPACs are a little bit different. So SPACs are companies that don't do anything themselves. They don't have a product, they don't provide a service, anything like that. They simply list their shares on the exchange to investors with the purpose of going to find a company to take public. Okay. Now, once they've done this, people have bought in, they've given them a bunch of money. They go away and they spend up to 2 years searching for a company they can take public. And say they find one, say a SPAC found Deliveroo. There's a whole bunch of negotiations backwards and forwards, terms agreed on, and a bunch of regulations that have to be met. And once all that's been done, they merge. Oop. So the SPAC and the company that they're taking public become one company that is now listed on the exchange through the previously floated shares of the special acquisition company. So they've got some cons and they've got some pros, as everything does. The main advantage for companies of going through a SPAC is that they happen a lot quicker than an IPO. So it can take just a few months for the company once they've been approached by the special acquisition company. But because they happen quicker, there's a lot of regulation they have to go through very fast. So that can make it a bit more difficult. So as I say, there's some pros and some cons. So what does this all mean for us? Why am I telling you about this? Maybe to you, the dual class shares don't matter. We don't have a lot of money, so we're not buying large bits of ownership in a company anyway. Well, for a start, it changes. These changes might attract more companies to us, which will mean more taxes. As companies are traded on the exchanges, every trade is taxed a little bit, and this accounts to a lot of revenue for the government. Obviously, for Americans and for the people in Europe, this doesn't matter to you guys, so sorry about that. For us in the UK, the trade taxes account for about £75 billion a year of income for the government, which is huge. It will also draw in companies. These changes, I say, advantage companies, advantage the founders, which could make a big difference to what companies choose to list where. This provides us better access. So I don't know if you guys have checked your apps, but not all brokerages, not all trading apps give you access to every company ever, right? So I can't, there was a company I wanted to buy that turned out to be listed on the Polish stock exchange, and I just couldn't access it through Hargreaves Lansdown. So that's a bit of a bugger for me. Having more companies list here will make bigger investors elsewhere ensure that their brokerages give access to our markets, which give more capital to companies here, and will also just make it easier for us to invest. It also means that when Cami ends up as a billionaire through his cannabis stocks, he might have difficulties buying ownership in companies if they've got dual listing of dual class share listings, which, you know, is something to consider for the future. So I hope that was interesting to you guys. Let me know what you think. Do you have any questions about any of that?